Welcome to the Deep Dive. Today we're looking into Crescent Capital BDC, ticker CCAP.
Yep, CCAP.
Their latest Q2 2025 results just dropped, and frankly, they tell a really interesting story about navigating, a pretty tricky market.
That's right. It's not just about the numbers, so we'll cover those. It's more about the strategy underneath, especially how they're handling capital and credit quality.
Exactly. So we're going to break down the financials, management's thinking, and, what it all potentially means for you listening in.
Let's get into it.
Okay, so first up, the headline numbers for Q2. What did we see?
Well, the net investment income, or NII, came in at $0.46 per share.
46 cents, okay.
Which was slightly below what analysts were expecting. The consensus was $0.48.
A small miss there.
But, and this is important, they pointed out a one-time accelerated amortization hit them for about $0.02 per share. So if you kind of mentally add that back.
Then they would basically hit the consensus number. Makes sense.
Exactly. And GAAP net income was $0.41 per share.
And what about total investment income?
That also came in a bit light. $42.99 million. The street was looking for closer to $44.6 million. And that's down about 12% from last year.
So income down a bit year over year, slight misses on NII and revenue, but you wouldn't know it from the market reaction, would you?
Not at all. That's the fascinating part. The stock actually popped pretty significantly on the day of the call.
Yeah, saw that. And much higher trading volume, too.
Right. So clearly, the market was looking past those, minor top-line misses and focusing on something else, something more fundamental, perhaps.
Definitely feels that way. Okay, let's look at another key figure then. Net asset value, NAV per share. What happened there?
NAV saw a very slight decrease, down 0.4% from the previous quarter. It settled at $19.55.
0.4%, that's barely a dip.
And really, that was mostly driven by a special dividend they paid out in June, 5 cents a share.
Oh, right. So it wasn't underlying performance dragging it down, just capital going back to shareholders.
Precisely. It shows the NAV itself is pretty stable. Now, the portfolio yield at cost, that did come down to 10.4%.
Down from 12.2% last year, I think?
Yeah, that's right. And that reflects what's happening more broadly, with base rates maybe drifting a bit lower off their peaks and definitely tighter spreads in the market. It's harder to get those super high yields now.
Everyone's seeing that pressure, but how are they positioned financially? Liquidity, debt?
Looking pretty solid there. They've got about $253 million in cash and undrawn capacity on their credit lines. Plenty of firepower.
And the leverage.
Debt to equity was 1.23 times, well within their target range. So, they're not stretching themselves thin on debt.
Okay. And quickly, non-accruals. Loans not paying interest.
Those stood at 3.9% based on the original cost of the loans, but only 2.4% based on their current fair market value.
Lower on a fair value basis, which is good. We should definitely dig into how they're managing credit risk later.
Absolutely, because that 2.4% doesn't tell the whole story of their approach.
Right. So we have the numbers laid out, slight income misses, stable NAV adjusted for the dividend, lower yield, solid balance sheet. But the market loved it. Let's unpack why. What's the deeper story here?
I think it really comes down to their capital allocation strategy and the signals they sent.
Okay.
So first, they declared the regular quarterly dividend, $0.42 per share for Q3, consistent payout.
Standard stuff there.
And they confirmed the final volatile 5-cent special dividend is coming. But the big news, the thing that I think really moved the needle.
The buyback.
Exactly. Yeah. A new $20 million share repurchase authorization.
And they were very explicit about how they plan to use it, weren't they?
Extremely explicit. They stated this program is designed to opportunistically repurchase shares when they trade below NAV.
That's a huge signal. Management basically saying, hey, market, you've got our price wrong, and we're going to step in and buy shares ourselves because they're cheap relative to what we think the assets are worth.
Precisely. It's a strong vote of confidence in their own portfolio valuation. They clearly believe that discount to NAV is unwarranted.
Especially when you look at their dividend coverage. You mentioned NII was 46 cents. Regular dividend is 42 cents. That's 110% coverage on the base dividend.
Right. They're earning more than enough to cover that regular payout, which gives them the flexibility and the justification, really, to use extra capital for buybacks when the stock is below book value.
Okay, so that strong capital return message clearly resonated. Let's talk about the portfolio itself that they have so much confidence in. What's the philosophy?
Their core identity, and they really hammer this home, is a disciplined focus on first-lien senior secured debt.
Meaning they're first in line to get paid back if something goes wrong?
Exactly. It's the safest part of the capital structure. 91% of their portfolio is in these first lien loans.
Wow, 91%. That's high.
It is, and it's very diversified, spread across 187 different companies. The average investment size is tiny, just 0.6% of the total portfolio.
So no single company blowing up can sink the ship.
Correct. And another key point, 99% of their debt investments are in companies backed by private equity sponsors.
Which usually implies a certain level of professional management and oversight from the PE firm. And you mentioned that loan to value, the LTV at underwriting, was around 39%.
Yeah, weighted average LTV around 39%. That means when they made the loan, the company's total value was significantly higher than the debt. It provides a big equity cushion for protection.
So first, Lowland, diversified, sponsor-backed, low LTV, it all points towards a strategy focused heavily on downside protection.
Absolutely. Capital preservation seems paramount. They also highlighted that 97% of their debt investments are floating rates.
Which helps when rates are high or rising.
Correct. It boosts their income in that environment, but it's a double-edged sword, right? If rates start falling significantly, their income would decrease too.
A calculated bet on the rate environment then. Okay, so how are they managing risk? Because even with a safe portfolio structure, you mentioned those non-accruals earlier, 2.4% at fair value. How do they get ahead of problems?
This is where their approach gets interesting. They talk about a preemptive approach using their internal watch list.
The watch list, right. How does that work?
So they rate their investments internally, and anything rated 3, 4, or 5 goes on this watch list. Now, this watch list represents 14% of the portfolio at fair value.
14%. That sounds quite high compared to the 2.4% actually not accruing interest.
Exactly. And that's the point. They're deliberately casting a wider net. They put companies on the watch list based on early signs of potential operational weakness, maybe a softening in revenue, before a loan payment is missed or a covenant is breached.
So they're not waiting for the fire alarm to go off, they're looking for smoke.
That's a good way to put it. It's about proactive monitoring, and they argue greater transparency. They're signaling potential areas of concern early.
And does having covenants help with that?
Immensely. They mentioned that 3 out of 4 companies in their portfolio have financial covenants.
Those tripwires we talked about.
Right. Those covenants force regular financial reporting and give CCK the right to step in and have conversations much earlier if performance starts to slip, rather than finding out after the fact. It enables that real-time visibility.
Okay, that makes sense. So pulling back to the bigger picture for investors, we're in this, complex environment, things like tariffs, inflation, potential slowdowns. How is CCAP navigating these broader challenges?
They addressed tariffs specifically, said the direct impact is pretty small, low single digits across the portfolio.
Okay, manageable.
And for those companies that are affected, they're seeing 2 main responses. One, companies with strong pricing power are just passing the cost through. Apparently that worked during the recent wage inflation too.
Interesting. And the second response?
Proactively finding different suppliers, moving sourcing around. They expect to see the full financial results of these shifts later in 2025. Seems like they feel it's under control.
And they also said something about uncertainty actually helping their deal pipeline. How does that work?
Yeah, a bit counterintuitive, right? But they noted that ongoing tariff talks and just general regulatory uncertainty can actually push private equity sponsors to sell companies sooner rather than later.
Trying to lock in gains before the rules change or the market turns.
Kind of like that. So it actually fuels the pipeline for potential exits. And even though overall M&A might be slower in volatile times, CCAP leverages its existing large portfolio.
How so?
They can focus on making add-on investments, lending more money to companies they already know really well, maybe for an acquisition or growth. And because they know the management teams, they often get to stay in the lead lender position, less reliant on chasing brand new deals in a competitive market.
Smart. Playing to their strengths.
Yeah.
Okay, let's talk track record. How has this strategy actually performed over time, especially compared to other BDCs?
This is probably the most compelling part of their story. They listed publicly back in February 2020.
Terrible timing, right before COVID hit.
Exactly. So their entire public life has been through the pandemic, supply chain chaos, rising rates, a real stress test. And through all that, from February 2020...
Well, the average BDC NAV did what?
The average public BDC's NAV per share fell by 10.5% over that same period.
Wow, that is a massive difference. So they preserved and even slightly grew book value while the sector average tanked.
It really highlights the effectiveness of their focus on credit quality and NAV stability. And if you look at total economic return, that's the NAV change plus all the dividends paid out.
Yeah.
CCAP delivered 49% over that period. Again, significantly outpacing the average BDC. Management points directly to this long-term focus on NAV stability as the driver.
It's hard to argue with those results. Are analysts buying into this story?
Seems so. There's a recent upgrade to outperform from one analyst firm, and the consensus price targets are hovering around $17.60 per share.
Which implies some decent upside from current levels, especially if that discount to NAV starts to close, potentially helped by the buyback.
That seems to be the thesis, yes. Continued solid execution, NAV stability, and the buyback helping to narrow that valuation gap.
All right. That brings us nicely to our This Is Not Financial Advice segment. Time to brainstorm an outrageous but maybe plausible trade idea based on all this.
Okay, let's think about this. We have CCAP trading significantly below its NAV.
Check.
We have management explicitly authorizing a $20 million buyback specifically to repurchase shares below NAV.
Double check. With conviction.
And we have a track record of NAV stability that absolutely crushes the peer average through very tough times.
Triple check. So what's the outrageous trade?
Okay, how about this? Go long CCAP, but here's the twist: you use broader market weakness as your entry signal, specifically weakness in the BDC sector itself.
So wait, when the whole BDC sector sells off, maybe reflected in an ETF like BIZD dipping.
Exactly. When BIZD dips, you buy more CCAP. You're essentially betting that CCAP's management will be aggressively using their buyback authorization precisely during those moments of sector weakness, snapping up their undervalued shares.
Huh. So you're leveraging expected volatility and betting on management's capital allocation discipline.
Right. The outrageous part isn't just going long CSKI. It's the conviction to add to the position when the sector is weak, trusting that CSKI's specific strengths, their credit quality, their NAV resilience, and that active buyback will lead to outperformance and NAV accretion, even while peers might be struggling.
It's like you're trying to front-run their buyback during dips, a bet on financial engineering and differentiated quality in a shaky market. I like it. Outrageous, but makes a certain kind of sense.
It's definitely leaning into this specific story they told on the call.
Okay, let's wrap this up. To recap, CCAP's Q2 call, despite maybe a couple of tiny misses on the surface numbers,
Really minor.
delivered a really strong message overall. Confidence in their credit quality, a clear commitment to returning capital, especially through that NAV-focused buyback.
Yeah, the market definitely heard that message loud and clear. Their focus on first-lien floating rate loans combined with that proactive, watch list-driven risk management. It seems to be working, judging by the historical NAV performance.
And that performance really sets them apart. They're making a very deliberate case that their shares shouldn't be trading at the discount they are, and they're backing it up with their own capital via the buyback.
It highlights that long-term strategy. Compound NAV, deliver steady income, and navigate these changing rate environments. They seem well positioned.
Absolutely. Now, remember, everyone, this has been a deep dive into the earnings call information. Nothing we've discussed here today is financial advice.
Nope, definitely
Yeah.
not. Always do your own homework.
Always conduct your own research, maybe talk to a financial professional before making any investment decisions.
So the question for you listening in is, what stands out to you from CCAP's approach? How does their focus on disciplined credit and very intentional capital allocation maybe influence how you look at investments, particularly in sectors facing, let's say, interesting times?
Food for thought. Thank you for tuning in to the deep dive. We hope this breakdown was valuable. We'll catch you on the next one.